This is Lunch Money.
Roger as well. It's Francis with a question, I think, on Hutchison. Is that right, Francis?
Yes, that's correct.
Thanks. Go ahead. Roger's listening.
Okay, what ranking would you give HTA now that they've joined up with Vodafone? Also, are they going to pay a dividend one day because their business seems to be flying along?
Sure.
One other question, ANZ, what's it worth?
Okay, well that's a lot of questions. I think you're getting more than your fair share, Francis.
He snuck it in. It's
You
all right.
did. Okay, let's go
Well
through
done.
them. Intrinsic value for Hutchison, 3 cents, 4 cents and 4 cents for the next 3 years. Do I think they're going to pay a dividend? They're a C4 business. If they've got any debt at all, and I suspect they do, and being a C4 business, it's not one that I spend a lot of time analysing very closely because I know based on my ratios that it's not worth spending some time on for me. I suspect that any extra cash that they generate may go to paying down that debt. So just be mindful of that before you're expecting dividends. Now, your other question was about ANZ. So we'll get that one up. Just one sec.
We'll get a chart up on screen
If we could pull a
viewers
chart up,
as
that'd
well.
be great.
Yeah,
Yeah,
that's
no
coming
problem.
up. There we go. There's one for viewers anyway.
So intrinsic value. Look, and bear in mind these are based on estimates, but I've got $24.77 for 2011 and about close to $28 for 2012. And at the moment, though, it's trading at a premium to its current intrinsic value, which is $21.27. So it's trading at a premium to its current value, but the value for 2011 and the value for 2012 is higher. But I like to buy businesses whose intrinsic value is going up and they're trading at a discount to their current intrinsic value.
Roger Montgomery, you were trying to say before, I guess, try and get away from the noise, the daily movements, the daily chatter about, one piece of data. But when the issues that we're hearing about, say, for example, in that package there, are the longer-term issues, deflation, elevated joblessness for many, many years, no growth, austerity measures completely, crimping any sort of growth in Europe. What do you do with that information then on a day-to-day basis, knowing that they are the long-term issues?
Well, nothing actually changes in terms of your investment approach or your investment strategy if you've got a sensible and rational one. If you've got a strategy that reacts to all that stuff, well, you're going to be kept busy for a long time. Whether or not that's profitable, it could be profitless prosperity in terms of your activity. What I tend to do is I say, okay, well, I actually think there are some concerns about global growth, and I think that's partly by virtue of the fact that we've got enormous debt globally, and the only thing that can cure debt is time to pay it off. Unless the powers that be turn around and say, you know what, we're going to forgive the world of all each other's debt, and if everyone agrees, sign here and away we go again. Assuming that doesn't happen, then, which I think is an absurd proposition, by the way, if that doesn't happen, then time is the only cure. You can't get out of a debt problem by borrowing more money. That only just defers the inevitable. You need a period of quite modest growth, if any growth at all. In that environment, good businesses will still do well. They'll buy market share from the companies that fail. We saw that with Harvey Norman and JB Hi-Fi, still around, but Clive Peters gone. And so you want to buy businesses that can take market share, so when the economy does eventually recover, they've got a bigger share of the market, they can charge higher prices, and away they go, they make even bigger profits. So you still operate the same way, you just need to buy the good businesses and you need to wait for them to be cheap.
All right, let's get one more caller, I think, before we have to finish up the program, Roger. It's Mitra from Townsville, I think. Mitra.
Yes, hi. Thanks for taking my call. And Roger, thank you for your book. I'm enjoying it very much.
I'm glad to hear it. Thanks for calling in. Let everyone know on the network that you like it.
It's the first financial book that I can actually put it down.
Great. All right, I'll send you the cheque. Thank you very much.
Just wanted to
I'm embarrassed now.
your thoughts on Woodside Petroleum, please.
Okay.
Any particular question?
It was about Woodside.
But okay, just
that's fine. I can. Happy to talk about the intrinsic value of this business. It is nowhere near. And you asked me earlier about oil, and I said, look, I'd rather look at the oil itself rather than the stock. This is a classic example why resource companies in Australia tend to be very expensive overall compared to their international peers. Australians seem to be willing to pay much, much higher prices than what our global investor peers are willing to do for their corresponding companies. This business has an intrinsic value of about $21.62 and it's trading at $40 or $41, so it's expensive. Mitra, I hope that's the answer you're looking for. I can't guarantee the price is going to go up or down.
Roger Montgomery, you do have a book out, and I will flag as well, we're interviewing you for our Read and Profit program, which will go to air on Tuesday, so we can hear more about that
good.
as well.
Thank you
so much.
It's
we
my
appreciate
pleasure.
your time. Roger Montgomery, you know him well. We love to have him in the program. So good to have him in on Lunch Money today.